Yes, recording is in process. Recording is in process, current and non-current assets. And as usually I do, I will show you videos and provide these videos with my short comments. So first question about definition of net sales and the concept of disclosure net assets in the financial reports. So there are three possible discounts that can be subtracted from the gross revenue or gross sales. And the question is how to consider these discounts and how to treat properly these discounts in order to prepare appropriate amount of sales for the income statement. So let's discuss three possible discounts: credit card sales to customers, sales discounts to business, and sales returns and allowances. Let's start with the first one, credit sales to customers.
Many consumers do not wish to carry large amounts of cash or their checkbooks. As a result, customers will be more likely to shop at a particular store if credit cards are accepted. The company could decide to issue its own credit card, which helps it to identify customers who are purchasing on account or on credit. The company could also decide to accept bank-issued credit cards, such as MasterCard or Visa. Doing so will allow the company to avoid the costs associated with keeping track of customer account balances, sending statements to customers, and processing customer payments. In addition, the company will be able to avoid the risk of loss when the company unwittingly accepts a bad check from a customer. Finally, because transactions involving bank-issued credit cards are cleared through the banking system, credit card receipts can be directly deposited in the company's bank account. The company then receives its money faster than it would if it provided credit directly to consumers. However, these benefits come at a cost. The credit card company charges a fee for the service it provides. That fee is referred to as a credit card discount. Let's assume that a customer purchases a $10,000 engagement ring using a credit card. The credit card company charges a 3% fee, which amounts to $300. When the jewelry store deposits its credit card receipt in the bank, it will receive credit for only $9,700, which equals the amount that will be reported as net sales on the company's income statement.
So, dear students, this is the first discount about recognition of credit card discounts, or in other words, credit card charges or debit card charges. It does not matter. Every time when customers make a payment, there is some cost for this payment. And of course, it's a reasonable question, who is responsible for this charge? And under the global approach, it's better to reduce this credit card or debit card or other type of payment charges from the gross amount of sales. So this is the first type of discounts that should be subtracted from gross sales. Let's take the second one, sales discounts to business. This is the most common instrument to promote sales, and normally companies use a lot of different sales discounts in order to attract customers and to increase their loyalty. Of course, it's a question how to treat these sales discounts.
Many companies face cash flow problems. They incur various costs long before delivering their products or services to customers. As you know, retailers allow customers to use credit cards to purchase products, which allow the retailers to receive the cash faster. However, most sales to other businesses are credit sales on open account. To motivate business customers to pay more quickly, many companies offer discounts for early payment. In addition, since customers tend to pay bills providing discounts first, a sales discount also decreases the chances that the customer will run out of funds before the company's bill is paid. When a company sells products on credit, credit terms are printed on the invoice or bill sent to the customer. Often credit terms are abbreviated. For example, if the full price is due within 30 days of the invoice date, the credit terms would be noted as net 30. Here, the N means the sales amount net of or less any sales returns, and the 30 means that payment is due within 30 days of invoice date. If a discount, often called a sales discount or cash discount, is granted to the purchaser to encourage early payment, those terms will be indicated on the invoice. For example, if the payment terms are 210 net 30, that means that the customer may deduct 2% from the invoice price if cash payment is made within the 10 days from the date of sale. If cash payment is not made within the 10-day discount period, the full sales price, less any returns, is due within 30 days of the invoice date. Let's assume that OfficeMax Incorporated sells $100,000 worth of supplies on credit with payment terms of 210 net 30. Assume that the customer pays within the 10-day discount period. To determine the amount of the customer payment, start with the invoice amount and deduct any returns to arrive at the amount that is due if the discount is not taken. Here, the sales discount is $2,000, which is the amount due of $100,000 times the discount percentage of 2%. The customer will subtract the discount from the amount due and send the company a check for $98,000. Sales discounts are deducted from sales revenues to arrive at the amount of net sales reported on the income statement.
Okay, again, this is the sale discount, and of course, in order to disclose information about actual sales, we should consider these sales discounts and subtract this from the gross initial or planned amount of sales. And the third one is a discount, which we call as sales returns and allowances.
Customers often have the right to return unsatisfactory or damaged merchandise and receive a refund or an adjustment to their bill. Such returns are often accumulated in a separate account called sales returns and allowances. This account allows managers to monitor the volume of returns and allowances, which is an important measure of the quality of customer service. Since sales returns and allowances reduce net sales, the sales returns and allowances account is treated as a contra revenue account. Assume that Shelving Solutions Incorporated sells 150 shelving units to IKEA for $30,000 on account. Before paying for the shelving units, IKEA discovers that 50 of the shelving units are defective and returns them. Shelving Solutions Incorporated would deduct the sales returns and allowances from sales revenues to arrive at the amount of net sales reported on the income statement.
And the third one, just to consider any sales returns and allowances in the case of damaged goods or some other reasons. And also we should consider these events when we calculate actual sales, or in other words, net sales. I hope now you understand what is the definition of net. Net, when we take gross amount of initial sales and subtract all possible discounts or all real available discounts. And these discounts can be at least three types: payment discounts, sales discounts, and sales returns and allowances. Now let's move to the next question about receivables. And the first moment, just to understand how to define receivables and how to classify receivables.
Receivables may be classified in three common ways. First, they may be classified as either an account receivable or a note receivable. An account receivable is created by a credit sale on an open account. On the other hand, a note receivable is a promise in writing to pay a specified amount, known as the principal, at a definite future date, known as the maturity date, and a specified amount of interest at one or more future dates. The interest is the amount charged for use of the principal. Receivables can also be classified as trade or non-trade receivables. A trade receivable is created in the normal course of business when a sale of merchandise or services on credit occurs. A non-trade receivable arises from transactions other than the normal sale of merchandise or services. Finally, receivables also are classified as either current or non-current, short-term or long-term on the balance sheet, depending on when the cash is expected to be collected.
So dear students, three classifications: accounts receivable or notes receivable, first one, Second one, trade or non-trade, and third one, current and non-current. For current and non-current, the main criteria is the maturity, so the time period, so the time period for cash collection. Trade or non-trade, of course, depends on the nature of the business. And accounts receivable or notes receivable, we understand this is the financial criteria. If we have any financial aspects in the contract, we consider as a notes receivable. Good. Now, how to treat receivables? There are some basic assumptions which we call as allowance method. This method explains how to treat receivables if there is any indicators that these receivables can develop some problems in the future with the payment. Let's see what does it mean, allowance method.
When a company sells on credit to its customers, management understands that it is unlikely that every customer will pay what is owed. When a customer's account becomes past due, the company will try to collect by contacting the customer and, if unsuccessful, may retain a lawyer or collection agency. If after these efforts the company still cannot collect, the account will be considered uncollectible. Such uncollectible accounts are referred to as bad debts. Why do companies sell on credit if they expect some accounts to be uncollectible? The answer is that companies believe that granting credit will increase total sales and net income enough to offset bad debts. The allowance method of accounting for bad debts matches the estimated loss from uncollectible accounts receivable against the sales they help produce. When the allowance method is used, bad debt expense is estimated at the end of each accounting period, and an adjusting entry is recorded. Let's assume that a company reported credit sales of $400,000 during its first year of operations. At the end of the first year, $30,000 of credit sales remain uncollected. Based on the experience of similar businesses, management estimates that $3,000 of its accounts receivable would be uncollectible. We will describe how this estimate is determined later in this learning module. This estimated expense is recorded with an adjusting entry that includes a debit to bad debt expense for $3,000 and a credit to allowance for doubtful accounts for $3,000. The estimated bad debt expense of $3,000 is reported on the income statement as a general and administrative expense and is matched against the $400,000 of credit sales. The allowance for doubtful accounts is a contra asset account. A contra account is used instead of reducing accounts receivable directly because at the time of the adjusting entry, the company does not know which customers will not pay. After the bad debt adjusting entry is posted, the accounts receivable account has a debit balance of $30,000, which represents the total amount owed by its customers, and the allowance for doubtful accounts has a credit balance of $3,000, which represents the amount that the company does not expect to collect. The difference between the two account balances equals the estimate of the amount that the company expects to collect from its customers of $27,000. The company starts with accounts receivable and subtracts the allowance for doubtful accounts to arrive at the book value of accounts receivable, which is reported on the balance sheet.
Okay, so this is a very important moment. Let me repeat briefly once again the logic, the idea. So imagine that we have credit sales. What does it mean? Customers owed to company or customers are promised to pay sometime in the future. And of course, the company, the seller has some expectations concerning these payments. And if the company considers that some of this amount, the portion of this amount will be not collected, of course, it's important to estimate this potential amount, which will be not paid, and to recognize this amount on the special account. The title of this account is Allowance for Doubtful Accounts. Look, allowance for doubtful accounts. It means that on this account, we accumulate the amount of accounts receivable which the company does not receive or have an expectation not to receive. And this amount should be recognized in correspondence under the dual concept, of course, with the bad debt expense, because it's a reasonable question. If we don't trust to our customers for payment, how we should treat these doubtful accounts as a bad debt expense and include into general and commercial expenses. And in order to disclose information in the balance sheet, we should take the gross accounts receivable and subtract allowances for doubtful accounts. And this net book value of accounts receivable should be disclosed in the balance sheet. Of course, next question, how to calculate, how to measure these possible or potential allowances for doubtful accounts. Let's discuss methods, percentage of credit sales method.
The allowance method requires an estimate of bad debt expense to prepare the adjusting entry at the end of each accounting period. There are two common methods for determining that estimate: the percentage of credit sales method and the aging of accounts receivable method. First, we will focus on the method that is based on the amounts that are reported on the income statement, sales and bad debt expense. The percentage of credit sales method starts with a number that is reported on the income statement, or sales, to determine another number that is reported on the income statement, or bad debt expense. The percentage of credit sales method is based on the idea that a given percent of a company's credit sales for the period is uncollectible. To illustrate, let's assume that a company has credit sales of $400,000. Based on past experience, management estimates that 0.6% of credit sales will be uncollectible. The estimated bad debt expense is $2,400, or $400,000 times 0.006. The adjusting entry to record this estimate expense includes a debit to bad debt expense for $2,400 and a credit to allowance for doubtful accounts for $2,400. The percentage of sales method is easy for the company and easy for you to compute. Very little data, such as credit sales, write-offs, and recoveries, need to be collected by the company to use this method. And after calculating the estimate, you simply use that estimate in the adjusting entry.
So the first method is a percentage of credit sales method, and it was told just now that this is a very simple method. What you should do just to collect information about previous credit history and to calculate the average percentage of credit sales which was not paid, and then to apply this assumption that in the future the same percentage will be not paid as well, and to calculate these allowances for doubtful accounts as multiplying with this estimated percentage rate, and then consider this amount as an allowance for doubtful accounts. So this is the logic of the first method. Let's discuss the second method, aging of accounts receivable method.
Now we will cover the second method of estimating bad debt expense, which is based on the balance sheet relation between accounts receivable and the allowance for doubtful accounts. This method is known as the aging of accounts receivable method. Before we illustrate it, it is important for you to realize that the goal of the bad debt adjusting entry for this method is to adjust the allowance for doubtful accounts balance so that it equals the estimated amount of accounts receivable that are uncollectible. This method is hard for the company and harder for you to compute. The company must maintain, collect, and consider more data to use this method. And after calculating the estimate, you need to look at the current balance in the allowance account, compare it to the estimate, and determine the amount of the adjustment required to make the balance in that account equal to the estimate. The aging of accounts receivable method uses both historical and current receivables information to estimate the amount of the receivables that will be uncollectible. That is, each customer account is aged or classified according to how long it is past its due date. The aging categories might include not yet due, up to 90 days past due, and over 90 days. Then estimates of uncollectible amounts are made for each aging category, assuming that the longer an amount is past due, the less likely it is to be collected. After the amounts are classified or aged, past experience is used to estimate the percent of each aging category. These percentages are applied to the amounts in each aging category and then totaled to get the estimated amount of accounts receivable that are uncollectible. We've calculated the estimate, but are not yet done. We still need to determine the dollar amount that is required for the adjusting entry. Recall that the estimated amount of accounts receivable that are uncollectible should equal the adjusted balance of the allowance for doubtful accounts. Assume that the allowance account has a $400 credit balance before adjustment. We have determined that this account should have a $3,600 adjusted balance. As a result, we need to increase the allowance account by $3,200. Accordingly, the adjusting entry will include a debit to bad debt expense for $3,200 and a credit of $3,200 to the allowance for doubtful accounts.
So dear students, in this method, the main procedure is the following. First of all, to age accounts into different categories. And please remember that this schedule that you observed in this video is not a rule. In every company, it could be developed its own classification for the periods, not yet due, of course, and then before 90 days, after 90 days, or 60 or 30 days, or maybe 180 days, or maybe another period. It depends on the schedule of sales and the terms of contracts. So this is the first moment. The second moment, just to estimate for each age or for each category the percentage rate of uncollectible amounts. And after that, to sum up all these amounts. And as a result, you calculate the estimated ending balance for allowance for doubtful accounts, not amount for required adjustments. Please remember, this is the main difference with the previous method. You calculate estimated ending balance. Once you have this estimated ending balance, next you should consider the beginning balance. And if this beginning balance is available from the previous periods, then you should calculate the required adjusting entry in order to reach this estimated balance. This is why in this particular case, when it was calculated the estimated balance, then to consider adjusted balance, and finally accounting adjusting entry has the following amount, 3,200. But the correspondent accounts are always the same. Bad debt expense on debit, you remember that all expenses always on debit, and allowances for doubtful accounts on credit, in order to recognize these amounts, in order to arrive to estimated balance of 3,600. Good. Good. So we just discussed these aging of accounts receivable method. You see on the list here we have some videos about ratios, but in this course we don't consider this financial analysis part. So this is what I would like to to discuss also, write-off specific uncollectible accounts and bad debt recoveries, because you understand that bad debt expense, it's an assumption, it's a prediction, but it's not 100% probability that this will be in the future. And of course, if estimations are not correct in the current period, we can get some situations which are differ from the predictions and real facts. And in order to adjust estimations to real facts, we should think about the process of recoveries. So let's watch these two videos.
When management has determined that a specific customer will not pay its debts, it is written off against the allowance for doubtful accounts. To illustrate, assume that a company determines that it cannot collect $1,000 owed to it by one of its customers. The entry to recognize or record the loss using the allowance method would include a debit to allowance for doubtful accounts for $1,000 and a credit to accounts receivable for $1,000. Since management does not expect to collect from this customer, the amount due from this customer no longer meets the test for an asset, since no future benefit is expected. Posting this write-off entry to accounts receivable removes the amount from that asset account. Recall that the balance in the allowance for doubtful accounts represented the estimate of the amount that the company did not expect to collect from customers. Now, we know that a particular customer will not pay. As such, when the write-off is posted to that account, the balance in that account will represent what we still expect not to collect. In this regard, it is important to note that the write-off does not affect the net book value of accounts receivable. The entry to write off a customer account does not affect total assets or net income.
So, dear students, what is important in this video, the explanation of matching concept. So we should match revenues and expenses for the same accounting period. And what is the logic of this allowance for doubtful accounts method? Just in the moment of revenue recognition, to recognize any potential losses, including these bad debts. This is why in the moment of sale, where we don't have any problems and any problems with the customers, we recognize any potential bad debts or any potential problems in the future. And we consider this amount as a potential amount of money which we classify as not expected to be payback, and subtract from the accounts receivable. But in the moment of actual write-off, you see, before write-off or after write-off, we write off against this allowance for doubtful accounts, and when you open the balance sheet, you will see absolutely the same data, before write-off and after write-off. This is why we should apply this method in order to smooth the impact or effect of write-offs. And when we recognize losses, we do not decrease net income. We just use this special reserve, this allowance, in order to make the financial result more stable, more consistent. So this is the logic of allowance method. And now through the procedure of write-off, you understand the concept and the objective of such method. And finally, bad debt recoveries.
Although uncommon, sometimes an account that is written off is later collected. This can be due to factors such as continual collection efforts or a customer's good fortune. Let's assume that a customer account in the amount of $1,000 was written off at the end of the previous year. A few months later, the customer sends the company a check for $250. When an account that was written off is later collected in full, two entries are recorded. The first entry reverses the write-off. As such, it includes a debit to accounts receivable for $250 and a credit to allowance for doubtful accounts for $250. The second entry records the collection on account. It includes a debit to cash for $250 and a credit to accounts receivable for $250. These entries include both a debit and a credit to accounts receivable. The debit and credit will cancel each other out. As such, why not prepare one entry that includes a debit to cash and a credit to bad debt expense? When we prepare and then post these two entries, the recovery will then be reflected in the customer account in the separate account kept for the customer, called a subsidiary account. A more complete customer history will result.
So, dear students, again, in a situation of recovery, we should adjust allowance for doubtful accounts, not bad debt expense. Look, it's a very interesting fact that we do not adjust bad debt expense. Once we recognize, we keep this amount. And this is why we should create this allowance for doubtful accounts in order to adjust any cases of recovery. Good. So now it's time to move to the second question. The second question is inventory. And first of all, let's start with the definition of inventory. What should we include in inventory when we calculate the initial cost or historical cost of inventory? Items included in inventory.
Inventory is tangible property that is held for sale in the normal course of business or used to produce goods or services for sale. Inventory is reported on the balance sheet as a current asset because it normally is used or converted into cash within 1 year or the next operating cycle. The types of inventory normally held depend on the characteristics of the business. Merchandisers comprising of wholesale or retail businesses hold merchandise inventory, which is goods or merchandise held for resale in the normal course of business. The goods usually are acquired in a finished condition and are ready for sale without further processing. Manufacturing businesses hold 3 types of inventory. Raw materials inventory is comprised of items acquired for processing into finished goods. These items are included in raw materials inventory until they are used, at which point they become part of work in process inventory. Work in process inventory is comprised of goods in the process of being manufactured, but not yet complete. When completed, work in process inventory becomes finished goods inventory. Finished goods inventory is comprised of manufactured goods that are complete and ready for sale. Goods in inventory are initially recorded at cost. Inventory cost includes the sum of the costs incurred in bringing an item to usable or saleable condition and location. When a company purchases raw materials or merchandise inventory, the amount recorded should include the invoice price to be paid, plus freight charges to deliver the items to its warehouses, freight in, plus any inspection and preparation costs, less any purchase returns and allowances, less any purchase discounts taken. In general, the company should cease accumulating purchase costs when the raw materials are ready for use or when the merchandise inventory is ready for shipment. Any additional costs related to selling the inventory to the dealers, such as marketing department salaries and dealer training sessions, are incurred after the inventory is ready for use. These costs are included in selling, general, and administrative expenses in the period in which they are incurred.
So, dear students, what is important to understand concerning inventory? First of all, we should classify every business into main categories. This is accounting approach. A trading business or merchandising business, first category, and the second, manufacturing business. In terms of inventory, there are different terminology. In merchandising companies, we use the term inventory, ready for sale, or merchandise inventory, and that's all. As for manufacturing companies, there are 3 stages in operating cycle, and for every stage, we use the appropriate term. For example, at the beginning of production, we use raw materials. After that, work in progress. This is a title of account, and then finished goods. But when we prepare a balance sheet, we aggregate, we sum up all these three categories: raw materials, work in progress, and finished goods into one item, inventory. So this is the first moment. The second moment concerning additional costs related to inventory. First of all, we have invoice price. Invoice price, or simply price, this is the amount of cash which was paid or will be paid to supplier. But also, there are several types of additional related costs, and the question how to treat. The approach is the following. All direct costs related to prepare inventory for the condition ready to use in business, we consider as a cost components. The typical examples are transportation costs, inspection costs. So this is the typical cases of direct costs. But also it could be some additional costs to push sales, to train personnel, or maybe something else. But these costs should be considered as indirect costs and included into selling, general, and administrative expenses. Flow of inventory costs. Next question. Flow of inventory costs.
The flow of inventory costs for merchandisers, wholesalers, and retailers is relatively simple. When merchandise is purchased, the cost of the merchandise purchased is added to merchandise inventory and asset account. When merchandise is sold, the cost of that merchandise is transferred to cost of goods sold and expense account. The flow of inventory costs in a manufacturing environment is not quite as simple. When raw materials are purchased, the cost of the raw materials purchased is added to raw materials inventory and asset account. Think of the raw materials inventory as being in a storeroom in a factory. When raw materials are moved from the storeroom to the factory floor, the cost of the raw materials used is transferred to work in process inventory and asset account. Think of the work in process inventory as the inventory that is sitting on the factory floor. Two other manufacturing costs are also added to work in process inventory when they are used. Direct labor cost represents the earnings of employees who work directly on the products being manufactured. Factory overhead costs include all other manufacturing costs. When the goods are completed and ready for sale, the related costs in work in process inventory are transferred to finished goods inventory. When the finished goods are sold, the cost of those goods are transferred to cost of goods sold.
So, dear students, once again, there are two types of business which, when we consider for the inventory accounting, merchandising business and manufacturing business. For merchandising business, the model is quite simple. We have one account for merchandise inventory, maybe with some specifications. In the moment of sale, we write off inventory from the balance sheet and recognize as a cost of goods sold. But as a for manufacturing business, the situation is the following. Of course, initially we recognize raw material inventory. But when we put these raw material to the factory floor, so we just consider as a work in progress. But of course, you understand that raw material is not enough to start the business process, production process. We also need some direct labor and some other factory overheads. This is why work in progress includes also direct labor and factory overhead. And finally, we get finished goods inventory. This is why for manufacturing companies, inventory amount includes not only initial raw material cost, but also direct labor and factory overhead. But finally, in a moment of sale, the procedure is the same as for merchandising business. We should write off finished goods from the balance sheet and recognize as a cost of goods sold. Now, let's discuss cost of goods sold equation.
Let's take a look at the relationship between cost of goods sold on the income statement and inventory on the balance sheet. A company starts each accounting period with a stock of inventory called beginning inventory. During the accounting period, new purchases are added to the inventory. The sum of the two amounts is the goods available for sale during that period. What remains unsold at the end of the period becomes ending inventory on the balance sheet. The portion of goods available for sale that is sold becomes cost of goods sold on the income statement. Note that the ending inventory for one accounting period then becomes the beginning inventory for the next period. The relationships between these various inventory amounts are brought together in the cost of goods sold equation, which is beginning inventory, abbreviated as BI, plus purchases, abbreviated as P, minus ending inventory, abbreviated as EI, equals cost of goods sold, abbreviated as CGS. To illustrate, assume that a company began the period with $40,000 of beginning inventory, purchased additional merchandise during the period for $55,000, and had $35,000 left in inventory at the end of the period. These amounts are combined to compute cost of goods sold as follows. Beginning inventory of $40,000 plus purchases of merchandise during the year of $55,000 equals goods available for sale of $95,000. Then, if we subtract the ending inventory of $35,000, we get cost of goods sold of $60,000. The amount of cost of goods sold and ending inventory can be determined by using one of two different inventory systems, perpetual or periodic. In prior chapters, we recorded all journal entries for purchase and sale transactions using a perpetual inventory system. In a perpetual inventory system, purchase transactions are recorded directly in an inventory account. When each sale is recorded, a cost of goods sold entry is also recorded, which decreases inventory and increases cost of goods sold. A detailed record is maintained for each type of inventory item, and this up-to-date record is maintained on a transaction-by-transaction basis. As a result, information on cost of goods sold and ending inventory is available on a continuous or perpetual basis. It's much more costly, but the benefit is that the information is available to managers when they need it. Under the periodic inventory system, the inventory account is not updated as transactions occur during the year. Detailed records are not maintained. As a result, when each sale is recorded, a cost of goods sold entry cannot be recorded since the required cost information is not available. An actual physical count of the goods remaining on hand is required at the end of each period. The number of units of each type of merchandise on hand is multiplied by the unit cost to compute the dollar amount of the ending inventory. Cost of goods sold must be calculated using the cost of goods sold equation. A periodic inventory system, which really isn't much of a system, is much less costly, but the disadvantage is the lack of inventory information. Information on cost of goods sold and ending inventory is available to managers only periodically when inventory is counted.
So, dear students, my short comment. First of all, about let's start with this system and goods available for sale. When we calculate goods available for sale, we should consider beginning inventory as ending inventory of the previous period plus all purchases during the period, and we consider this as goods available for sale. And at the end of the period, we have ending inventory. In order to compute properly cost of goods sold during the period, we should take goods available for sale and subtract ending inventory. Now about two accounting systems, perpetual inventory system and periodic inventory system. Of course, as it was mentioned in video, companies normally use perpetual inventory system because this system provides the actual information about inventory flows and allows a good managerial information for decisions to keep inventory in a required quantity. So as for the periodic inventory system, this system also less expensive, but we cannot get actual information in any moment of time during the period. So why? Because cost of goods sold entry cannot record it in the moment of sale. This is only an adjusting entry at the end of the period. So no records during the period, all records at the end, in order to just physical availability of inventory in the store with the initial amount of beginning inventory plus purchases. Now, let's discuss inventory cost and methods.
How do we determine the cost of ending inventory and the cost of goods sold? When all units are purchased at the same unit cost, this process is simple. However, that is rarely the case. Let's assume the following. We begin the period with 2 units in beginning inventory at a cost of $70 per unit. On January 12th, we purchased 4 units at $80 per unit. On January 14th, we purchased 1 unit at $100 per unit. We now have 7 units available for sale at a total cost of $560. On January 15th, we sold 4 units for $120 each. We now have 3 units in ending inventory. The answer to our question about how to determine the cost of ending inventory and the cost of goods sold depends on the inventory costing method that is in use. 4 methods are commonly used to assign cost to inventory and to cost of goods sold: specific identification, first in, first out, last in, first out, and average cost. The specific identification method is impractical when large quantities of similar items are stocked. As such, we will not illustrate it here. Most inventory items are accounted for using one of the other three cost flow assumptions. Each method assumes a particular pattern of how costs flow through inventory. Each of these four methods is acceptable whether or not the actual physical flow of goods follows the cost flow assumption. Physical flow of goods depends on the type of product and the way it is stored. Perishable goods, such as fresh fruit, demand that a business attempt to sell them in a first-in, first-out physical flow. Other products, such as crude oil and minerals such as coal, gold, and decorative stone, can be sold in a last-in, first-out physical flow.
So, dear students, this video about inventory costing methods to recognize the flow of inventory. As you understand, the flow of inventory is quite fast, and also we can have some different prices for the different physical amounts of inventory. And of course, it's a question how to calculate cost of goods sold and ending inventory. There are four methods: specific identification, first in, first out, last in, first out, and average cost. As it was mentioned, specific identification is not for mass production. This is we are not going to discuss this method, and we just look on the first in, first out, last in, first out, and average cost. So let's discuss each method in detail. First in, first out.
The first in, first out method, frequently called FIFO, assumes that the earliest goods purchased, the first ones in, are the first goods sold, and the last goods purchased are left in ending inventory. You'd want to sell a perishable product, such as gallons of milk, in this manner. Let's walk through the process step by step. First, each unit purchased is treated as if it were deposited in the bin from the top in sequence. 2 units of beginning inventory at $70, followed by the purchase of 4 units at $80, and the purchase of 1 unit at $100. Adding together the beginning inventory and the purchases gives us goods available for sale of $560. FIFO allocates the oldest unit cost to cost of goods sold and the newest unit cost to ending inventory. Recall that we assumed that the first unit purchased, first in, is the first unit sold, first out. Recall that 4 units were sold. That is, each unit sold is removed from the bottom in sequence. The first unit at $70, the second unit at $70, the third unit at $80, and the fourth unit at $80. The cost of these units, totaling $300, becomes cost of goods sold. The remaining 3 units, which are comprised of the 2 units at $80 and the remaining 1 unit at $100, becomes the cost of the ending inventory of $260.
So, dear students, first in, first out method. The logic is first in and first out. So the basic rule for this method that the oldest purchases will be included in the cost of goods sold and the most recent in the ending inventory. So this is the logic of cost of FIFO method. FIFO method. LIFO method. Last in, first out.
The last in, first out method, frequently called LIFO, assumes that the last goods purchased, the last ones in, are the first goods sold, and the earliest goods purchased are left in ending inventory. Imagine that you are selling candy from a barrel. Every time you purchase candy, you add it to the barrel. As customers buy candy, they scoop it from the top of the barrel. Let's walk through the process step by step. First, each unit purchased is treated as if it were deposited in the bin from the top in sequence. 2 units of beginning inventory at $70, followed by the purchase of 4 units at $80 and the purchase of 1 unit at $100. Adding together the beginning inventory and the purchases gives us goods available for sale of $560. LIFO allocates the newest unit cost to cost of goods sold and the oldest unit cost to ending inventory. Recall that we assumed that the last unit purchased, last in, is the first unit sold, first out. Recall that 4 units were sold. That is, each unit sold is removed from the top in sequence, the first unit at $100, the second unit at $80, the third unit at $80, and the fourth unit at $80. The cost of these units, totaling $340, becomes cost of goods sold. The remaining 3 units, which are comprised of the 2 units at $70 and the remaining unit at $80, becomes the cost of the ending inventory of $220.
So, dear students, in last in, first out method, the main approach is to allocate the newest unit cost to cost of goods sold and the oldest unit to the ending inventory. Look, in this case, in this particular case, we take the newest unit cost 103 of 80 to the cost of goods sold, and the ending inventory is the oldest unit cost to ending inventory. And finally, the last method, which we call average cost method or weighted average cost method of allocating inventory costs.
The average cost method, also known as the weighted average cost method, uses the weighted average unit cost of the goods available for sale for both cost of goods sold and ending inventory. Here, imagine a gas station that has a large underground tank. As a tanker adds gasoline to the tank, it mixes with the existing gasoline. Customers then pump a mixture of the old and new into their gas tank as they fill up. The weighted average unit cost of the goods available for sale is computed by dividing the cost of goods available for sale by the number of units available for sale. Therefore, by dividing the cost of the goods available for sale of $560 by the 7 units available for sale, we get an average cost of $80 per unit. We multiply the 4 units sold by the average cost of $80 per unit to obtain the cost of goods sold amount of $320. We also multiply the 3 units still on hand by the average cost of $80 per unit to calculate the ending inventory amount of $240. Cost of goods sold and ending inventory are assigned the same weighted average cost per unit.
So in this method, as you see, the main technique is the following. First of all, to compute average cost, just to consider cost of goods sold available for sale, how to calculate goods available for sale, to take beginning inventory and add all purchases. And after that, divide by the number of units available for sale. And then we consider average cost. In this average cost, we should apply respectively to the cost of goods sold and to the ending inventory and calculate these amounts. Of course, it's a question, what methods should we choose based on our managerial expectations and managerial questions? So let's watch this video about manager choice of inventory methods, and we understand what is the main criteria to choose the specific method.
Most managers choose an accounting method based on 2 factors. Number 1, net income effects. Managers prefer to report higher earnings for their companies. Number 2, income tax effects. Managers prefer to pay the least amount of taxes allowed by law as late as possible. Any conflict between the 2 motives is normally resolved by choosing one accounting method for external financial statements and a different method for preparing a company's tax return. The choice of inventory costing method is a special case, however, because of what is called the LIFO conformity rule. The rule states that if LIFO is used on the U.S. income tax return, it must also be used to calculate inventory and cost of goods sold for the financial statements. When inventory costs are increasing, managers will choose to use LIFO on the tax return because it normally results in lower income taxes. The LIFO conformity rule then leads companies to adopt LIFO for both tax and financial reporting purposes for increasing cost inventories located in the United States. On the other hand, when faced with decreasing inventory costs, FIFO is most often used for both the tax return and financial statements. A company is not required to use the same inventory costing method for all inventory items, and no particular justification is needed for the selection of one or more of the acceptable methods. However, accounting rules require companies to apply their accounting methods on a consistent basis over time. A company is not permitted to use LIFO one period, FIFO the next, and then go back to LIFO. A change in method is allowed only if the change will improve the measurement of financial results and financial position.
So, dear students, why this video is important? Of course, you put attention that this is about U.S. taxation and other issues. I would like to comment the following. Currently, LIFO method is prohibited under International Financial Reporting Standards. LIFO method is also prohibited in Russian Federation. But in other countries, you can find this LIFO method in force. For example, in United States, LIFO is not prohibited. This is the reason why we learn all three methods. We don't know what will be in the future. So let's discuss all these methods, but put in mind that currently, LIFO is prohibited under IFRS and under national Russian standards. And at the second moment that when you apply any method, so in this case, we have only two possible FIFO or weighted average, we should apply this method on a consistent basis. So you cannot jump from one method to another. This is also the basic approach, and this is the global approach. So this is about the methods, and I would like also to mention some moment of history. LIFO method initially was developed in United States of America. So the origin of LIFO method is USA. Well, now let's discuss the last question concerning inventory to evaluate inventory, ending inventory at the current market price, and we call this method at lower cost of net realizable value. So this method, in accordance with international standards and in Russian Federation, we also have this requirement. So let's watch and learn how to treat.
Costs are assigned to ending inventory and costs of goods sold using one of the four costing methods: specific identification, FIFO, LIFO, or average cost. The net realizable value of an inventory item equals its sale value less cost to sell. When the net realizable value of goods remaining in ending inventory falls below cost, these goods must be assigned a unit cost equal to their current estimated net realizable value. This rule is known as measuring inventories at the lower of cost or net realizable value. Under the lower of cost or net realizable value, a company recognizes a holding loss in the period in which the net realizable value of an item drops. The holding loss is the difference between the purchase cost and the lower net realizable value. Assume that Able Company has two items in its ending inventory. The 100 units of A100 are carried in ending inventory at their cost of $10 per unit, and the 300 units of B200 are carried in ending inventory at their cost of $22 per unit. At the end of the accounting period, management estimates the net realizable value, or market value, of the units of A100 to be $12 per unit. Because the cost of each unit of A100 is lower than its net realizable value, these units will be carried at their cost of $10 per unit, and no write-down is required. Management estimates the net realizable value of the units of B200 to be $17 per unit. Because the net realizable value of each unit of B200 is lower than its cost, these units must be carried at their net realizable value of $17 per unit, and a write-down from cost to net realizable value is required. Able Company will record the write-down of the units of B200 that are in ending inventory by debiting cost of goods sold for $1,500. This is computed by multiplying the 300 units by the difference between the $22 cost per unit and the $17 net realizable value per unit. inventory will be credited for the same amount.
So, dear students, what is the concept of net realizable value? The concept of net realizable value is to control, to observe the external environment, and regularly compare cost of inventory with the external market price. What is the net realizable value? This is the selling price minus cost of sales. So this is why we use the word net. Net, what does it mean? Selling price, but also we should consider cost of sale and subtract in order to get this net realizable value. And if you find the net realizable value is less than the cost, then we should adjust the existing cost to net realizable value and to recognize its potential holding loss. It's not actual loss because we don't have any flow in the inventory. This is the estimation process. This is why we call this loss or this loss as a holding loss. And also, it's a question, how should we treat this holding loss? First of all, we should write off inventory in order to get this new net realizable value. Look here, we should decrease 22 to 17. And also, we should consider the classification of these potential loss of inventory. And we should consider as a cost of goods sold, because cost of goods sold, this is the cost of inventory. Of course, it's reasonable to adjust write-off of cost to net realizable value as a direct cost of inventory and add to the cost of goods sold. And the last question for today's lecture, is to discuss property, plant, and equipment. In the last lecture, we already mentioned this material, but let me start from the very beginning. I mean property, plant, and equipment treatment in all questions. And first of all, discuss acquisition cost once again. What does it mean, acquisition cost, for property, plant, and equipment?
All reasonable and necessary expenditures made in acquiring and preparing an asset for use should be recorded as the cost of the asset. We start with the acquisition cost, which is the net cash amount paid for the asset, or, when non-cash assets are used as payment, the fair value of the asset given, or asset received, whichever can be more clearly determined. Any sales taxes, legal fees, transportation costs, and installation costs are then added to the purchase price of the asset. Renovation and repair costs incurred by the company prior to the asset's use should be included as part of its cost. Also, when purchasing land, buildings, and equipment as a group, known as a basket purchase, the total cost is allocated to each asset in proportion to the asset's market value relative to the total market value of the assets as a whole. Let's assume that a company purchases a machine with an invoice price of $25,000 and receives a trade discount of $500 from the vendor. Thus, the net cash invoice price is $24,500. If the company pays transportation charges in the amount of $750 and incurs installation costs of $1,250, the total cost of the machine is $26,500. The purchase would be recorded by debiting the machinery account and crediting the cash account for $26,500. Typically, any interest charges incurred to finance the purchase of property, plant, and equipment are expensed as incurred. However, in some cases, a company may construct an asset for its own use instead of buying it from a manufacturer. In this situation, the cost of the asset includes all the necessary costs associated with construction, such as labor, materials, and, in most situations, a portion of the interest incurred during the construction period, called capitalized interest. The amount of interest expense that is capitalized is recorded by debiting the asset and crediting cash when the interest is paid. The amount of interest to be capitalized is a complex computation discussed in detail in other accounting courses.
Okay, so dear students, once again, acquisition cost as for inventory as to property, plant, and equipment, the same approach. Acquisition cost, initial cost, this is a basket of direct purchase price plus all additional direct costs. But if we consider constructed assets as a property, plant, and equipment, then we have the other structure, and acquisition cost includes labor costs, material cost, and capitalized interest. But anyway, we have the same accounting entry. We should increase an account of property, plant, and equipment and decrease cash in the moment of payment. Repairs, maintenance, and improvements.
Most assets require substantial expenditures during their lives to maintain or enhance their productive capacity. Expenditures that are made after an asset has been acquired are classified as follows. Ordinary repairs and maintenance are expenditures that maintain the productive capacity of the asset during the current accounting period only. These expenditures are recurring in nature, involve relatively small amounts at each occurrence, and do not directly increase the productive life, operating efficiency, or capacity of the asset. These cash outlays are recorded as expenses in the current period. Improvements are expenditures that increase the productive life, operating efficiency, or capacity of the asset. They occur infrequently, involve large amounts of money, and increase an asset's economic usefulness in the future through either increased efficiency or longer life. Examples include additions, major overhauls, complete reconditioning, and major replacements and improvements. These capital expenditures are added to the appropriate asset accounts, that is, they are capitalized.
So, dear students, once again, we should classify all expenditures which are devoted to the property, plant, and equipment as ordinary repairs and improvements. So, and also we have two different approaches in accounting treatments. As for ordinary repairs and maintenance, we should recognize all expenses in the moment of its occurrence, so as a periodic costs. As for improvements, these improvements should be capitalized. What does it mean to be capitalized? These expenses should be added to the acquisition cost of property, plant, and equipment. Now about the factors in computing depreciation.
Except for land, which is considered to have an unlimited life, a long-lived asset with a limited useful life, such as a truck, represents the prepaid cost of a bundle of future services or benefits. The expense recognition, or matching principle, requires that a portion of an asset's cost be allocated as an expense in the same period that revenues are generated by its use. Depreciation is the process of allocating the cost of buildings and equipment to expense over their useful lives. An adjusting journal entry is needed at the end of each period to reflect the use of buildings and equipment for the period. That entry includes a debit to depreciation expense, which is reported on the income statement, and the credit to accumulated depreciation. This contra account accumulates the amount of depreciation recorded since the acquisition date of the asset. Accumulated depreciation is deducted from the asset's cost to arrive at the net book value, or carrying value, of the long-lived asset, which is the amount that is reported on the balance sheet. Depreciation is a systematic and rational allocation of the costs of the asset. It is an estimate. The three factors that determine the amount of depreciation recorded each period are 1. Acquisition cost, 2. Estimated useful life to the company, which represents management's estimate of the asset's useful economic life to the company, rather than its total economic life to all potential users. And 3. Estimated residual or salvage value, which represents management's estimate of the amount the company expects to recover upon disposal of the asset at the end of its estimated useful life. Various depreciation methods are used to allocate a plant asset's cost over the accounting period in its useful life. The most frequently used method of depreciation is the straight line method. Other common depreciation methods include the units of production method and the declining balance method.
So, dear students, this video about depreciation. First of all, once again, definition of depreciation. Depreciation, this is the cost allocation of long-lived assets into several accounting periods in order to match revenues and expenses for the same accounting period. In order to allocate, we need three sources of information. First of all, the initial acquisition cost. then the useful life or the period of usage of this asset, and finally a residual value, the value at the end of the useful life. And also we need to determine to choose depreciation method. So frequently used in business is the first one, straight line method, and we discuss in our course. But also there are two other available methods: units of production and decline in balance. What I would like to say, so for our course, it's compulsory to understand the straight line method. As units of production and decline in balance, it's a voluntary information. If you read the textbook or listen textbook, you will find you will find material about these methods. So I recommend you to read and to understand the concept. But in our exercises, in our tests, we cover only straight line method. So let's discuss what is the content of straight line method.
The straight line depreciation method charges the same amount of expense to each period of the asset's useful life. Let's assume that the company purchased a machine at the beginning of year one. The machine cost $10,000 and is expected to have a residual value of $1,000 at the end of its useful life of 3 years. The machine is expected to produce 4,500 units of product. Because we are about to prepare annual financial statements, we need to compute the depreciation of this asset so that we can record it in an adjusting entry at the end of the year. We will use the straight line method. When the straight line method is used, depreciation is computed by multiplying the difference between cost and residual value, which is referred to as depreciable cost, by 1 divided by the asset's useful life in periods, which is referred to as the straight line rate. Using the straight line method, let's compute the annual depreciation of this machine. The depreciable cost of $9,000 equals the cost of $10,000 minus the residual value of $1,000. The straight line rate of 33.33% equals 1 divided by the 3-year estimated useful life. Multiplying these two figures gives us the depreciation expense of $3,000 per year. Companies often create a depreciation schedule that shows the computed amount of depreciation expense each year over the entire useful life of the asset. When the straight line method is used, notice that depreciation expense is a constant amount each year. Accumulated depreciation increases by an equal amount each year. Net book value decreases by the same amount each year until it equals the estimated residual value.
Okay, so dear student, please read in the textbook and analyze these straight line method schedule. In our classes, we will prepare these tables and discuss all computations. And right now we have one more question concerning property, plant, and equipment. This is disposal of property, plant, and equipment.
A business may dispose of an asset involuntarily as the result of a casualty, such as a storm, fire, theft, or accident. However, more likely, a company may voluntarily decide not to hold a long-lived asset for its entire estimated life. The company may drop a product from its line and no longer need the equipment that was used to produce it. A manager may decide to replace a machine with a more efficient one. These disposals include sales, trade-ins, and retirements. Disposals of long-lived assets seldom occur on the last day of the accounting period. As a result, depreciation must be recorded on the date of disposal for the amount of cost used since the last time depreciation was recorded. Therefore, the disposal of a depreciable asset usually requires two journal entries. One, an entry to update the depreciation expense and accumulated depreciation accounts through the date of the disposal. Two, an entry to record the disposal. The difference between any resources received on the disposal of the asset and its net book value on the date of disposal is treated as a gain or loss on the disposal of the asset. A gain is recorded if the resources received exceed the net book value of the asset. A loss is recorded if resources received are less than the net book value of the asset. The gain or loss is reported in operations on the income statement. Let's assume that we sell a piece of equipment on July 1st for $3,500. The equipment, which cost $10,000, had accumulated depreciation of $6,000 as of the previous December 31st. This equipment was being depreciated using the straight line method over 5 years with zero salvage. First, we need to bring depreciation up to date through the date of disposal. The depreciation for the first 6 months of the current year equals $1,000, which is computed by taking the cost of $10,000 minus the salvage value of $0, dividing the result by 5 years, and then multiplying by 6/12 for January 1st through June 30th of the current year. The first entry includes a debit to depreciation expense and a credit to accumulated depreciation for $1,000. Now, we record the sale of the equipment. Because the equipment has a net book value of $3,000 or cost of $10,000 minus the updated accumulated depreciation of $7,000 when it is discarded, the company must recognize a gain of $500. The entry to record the disposal includes a debit to cash for $3,500, a debit to accumulated depreciation for $7,000, a credit to equipment for $10,000, and a credit to gain on sale of assets for $500.
So dear students, this video is a little bit more technical, how to recognize gain or loss on disposal of assets. On our seminars, we discuss and we do exercises. And also, I would like to say that in this topic, we have intangible assets, but our time is over now, and I don't want to ask for some extra on your behalf. It could be some other lectures to you today. So as for intangible assets, please read in the textbook, and next lecture I will show you the video and we repeat this material, and also we discuss on our seminars. In general, I can say that the treatment for intangible assets is quite similar as for property, plant, equipment. Again, cost allocation, but instead of depreciation, we use the term amortization. Also useful life and residual value. By the way, we can use the synonym for residual value as a salvage value. As you noticed in the videos, we have different terms for the same item. And as for intangible assets, we also discuss some specifications concerning intangible assets with indefinite useful life. But this material we cover on our next seminar, and also next lecture. I will repeat briefly some moments from this video as well. So, dear students, thank you very much for your attention. So right now I will start recording. I strongly recommend you to watch video of this lecture, to repeat some materials and to do exercises. And see you on Friday and on Monday and on next Tuesday as well.
Thank you. Goodbye.
Thank you. Bye-bye.
Thank you. Goodbye.
Bye-bye. Yeah.